Every modern nation keeps a ledger. Ink runs in columns: assets, liabilities, revenues, deficits. On the surface, it looks technical: numbers, percentages, the sober language of finance ministers and bond markets. But beneath the spreadsheets, there is a quieter, stranger truth. A world built on promises instead of property, on obligations that bind countries together in invisible chains. Every country is drowning in debt. Trillions are owed. Yet if every government, corporation, and household is borrowing at the same time, if everyone owes someone else, who remains to be the collector? The question itself feels like a trick, a magician's misdirection that invites you to look where nothing meaningful is happening. But look closer, and the misdirection reveals the architecture of our shared reality. Imagine a map of the planet lit at night. The glow is not just electricity, it is credit extended and repaid. Credit that fuels factories, funds wars, builds hospitals, and kicks off speculative bubbles. When a country issues a bond, it is offering a promise: pay me back with interest. When another country buys that bond, it is converting its own sovereign promise, its own surplus or savings, into an instrument of trust. The transaction seems simple: lender, borrower. But when every ledger is full of such promises, the old categories begin to blur. Lenders are borrowers, creditors are debtors. The system becomes a mirror hall of IOUs, reflecting obligations back and forth until the notion of a solitary creditor, a single collector who stands above the rest, starts to feel outdated. And yet, there must be something that holds this hall together. A force, perhaps, that is less a person and more an arrangement of faith, data, and incentives. Welcome to the History of Debt, where we explore how money, power, and history weave the world we live in. Because if the entire planet is trapped in the same system, maybe the real creditor isn't a person at all. Maybe it's a machine built from rules and reputations, a structure that rewards patience but punishes doubt. And so our story begins not with a villain, but with a relationship. Nations, like people, who learn to carry one another's promises as if they were anchors. The paradox is simple. Debt both creates and consumes value. It is fuel and trap, ladder and leash. To understand who benefits, who yields, and who ultimately commands, we must first accept that debt is not merely arithmetic. It is a story we tell ourselves about trust. Debt, in the modern sense, is a remarkably capacious idea. At its most prosaic, it is a contract, a note promising to repay. At its most profound, it is a social technology that turns future work into present capital. The reason governments borrow is not because they prefer interest payments. It is because borrowing allows them to act now. They can build roads, wage wars, fund schools, and smooth consumption across political cycles. For economies, debt lubricates the gears. It lets investment precede income. It turns expectations about tomorrow into machines for today. But lubrication has a cost. The more a system relies on promises instead of tangible exchange, the more it depends on a shared belief that those promises will be honored. That belief becomes the real collateral. Across the 20th and 21st centuries, debt has become the foundation of the global economy. After the wars and depressions, states did not retreat from financial markets. They leaned into them. They created currencies, built central banks, and designed institutions that could measure, price, and redistribute risk. Private actors, too, found new ways to package promises, from corporate bonds to mortgage-backed securities, expanding the web of obligation across borders and balance sheets. Today, when an emerging market issues sovereign debt, Western pension funds, Chinese reserves, and hedge funds might all take part. The act of borrowing is simultaneously local and planetary. That interdependence is what makes the paradox so profound. The sovereign who issues a bond is both asserting independence and inviting external influence. Sovereignty becomes negotiable in the marketplace of promises. If debt is the oxygen of modern finance, then the distribution of that debt is the anatomy of power. Look at the world of bond markets, and you will find a geography of influence. Some countries lend with the confidence of empires. Others borrow with the urgency of necessity. Yet the categories shift over time. Once, Colonial powers accumulated real assets, raw materials, colonies, dominions. Today, influence often travels through portfolios. Sovereign wealth funds, pension systems, and global banks hold slices of other countries' liabilities. When China owned large amounts of U.S. Treasury debt, the headlines labeled it a geopolitical lever. But that telling misses something important. The ownership of debt does not always translate into straightforward control. A creditor who depends on the functioning of the debtor's economy, because their exports rely on it, or because their own securities would lose value if the debtor defaults, often finds themselves constrained. That is the first layer of the illusion. Ownership does not equal power in a linear sense. It is instead a knot of interdependence. The holder and the issuer are stuck in a bind that resembles partnership more than domination. To trace who actually holds the planet's debts, follow the paper trail. Central banks sit at the heart of the system, operating as both lenders of last resort and stewards of monetary faith. Private institutions, global banks, hedge funds, life insurers, act as intermediaries, buying and selling sovereign and corporate obligations. Pension funds and insurance companies cradle long-duration claims, betting on stability and steady returns. Then there are sovereign wealth funds, national treasuries, and international institutions like the IMF that step in when confidence frays. Each actor has its own motives. Central banks seek stability. Hedge funds seek profit. Pension funds seek predictable payouts to retirees. In the aggregate, they compose an architecture designed to allocate capital across time and space. Consider how this plays out in practice. When the United States issues treasuries, it is not simply borrowing from anonymous markets. Foreign governments hold a large share of those securities, parking reserves in the form of U.S. debt, because the dollar functions as the primary medium of global exchange. China and Japan, among others, accumulate these assets to stabilize their own currencies and to keep exports competitive. European debts, meanwhile, are often held by a mix of domestic banks and foreign investors, with American funds increasingly participating in European sovereign and corporate markets. Emerging market bonds attract yield hunters from developed economies searching for returns in a low-interest environment. Each trade layers another relationship onto the globe: creditor, debtor, reinvestor, speculator. The holdings are real, the flows are measurable, but the meaning, who benefits, who wields power, is not self-evident. And herein lies the deeper mystery. If creditors are themselves embedded in networks that rely on the continued solvency of their debtors, how does hierarchy emerge at all? The answer is not conspiratorial, it is procedural. Risk is distributed unevenly by design. Some assets are deemed safe, liquid, reliable, and desirable. Others are labeled risky. Those labels shape behavior. They determine interest rates, allocation of capital, and the terms under which states can finance themselves. Credit rating agencies, central bank policies, and legal frameworks create an ecosystem where some borrowers enjoy the privilege of low rates and high demand, while others pay a premium for the same promise. This system of valuation is subtle and consequential. It steers capital to places deemed trustworthy and starves those thought otherwise. Over time, these mechanisms create asymmetries in bargaining power. A nation that borrows cheaply in global markets gains room to maneuver. A nation forced to borrow at punitive rates must make painful adjustments. The result is not always a conscious exercise of control, but it is control nonetheless. A plumbing of incentives that channels resources in ways that often reinforce existing hierarchies. Debt also exercises power through psychology. The fear of default, the dread of inflation, the need to maintain a credit rating, these are not merely abstract concerns. They shape policy decisions that affect millions: austerity measures, subsidy cuts, labor reforms. Governments learn to listen to markets as if they were a public opinion more accurate than elections. Politicians who disregard the bond vigilantes find themselves at the mercy of higher yields and dwindling options. The lesson is sober. When expectations matter as much as resources, the ability to influence expectations becomes a lever of governance. Private actors, from rating agencies to large institutional investors, wield outsized influence because their perceptions can change the cost of borrowing overnight. In that sense, the power of debt is diffuse but sharp. It penetrates the political fabric without occupying a single throne. As these layers accumulate, the question returns: who sits above this entangled web? There is no single sovereign creditor, no omnipotent collector. Instead, there is a system, an arrangement of protocols, reputations, and instruments that functions as the effective creditor. It is not a person you can confront or a government you can overthrow. It is a machine of expectation. It consists of the belief that promises will be repaid, the legal frameworks that enforce those promises, and the infrastructures, payment systems, exchanges, clearinghouses that make repayment possible. When those elements align, credit flows. When they fracture, panic spreads. The system rewards trust and punishes its absence. In that sense, the creditor is collective. It is the market's willingness to accept a promise as money's future. Metaphor helps here. Think of the financial system as a vast cathedral built of glass. Each pane is a promise, transparent and fragile. The cathedral casts a light that guides economic activity, but no single mason stands above the structure. The light persists only because millions choose to see in the same way. Or imagine a ghost, intangible, present, because we agree it exists. The financial system is that ghost, not supernatural, but a creature of shared belief. When that belief wanes, the ghost dissipates and the cathedral trembles. And yet, for all its ethereality, the system has material effects. When faith falters, people lose jobs, currencies fall, pensions shrink. Belief is not an abstract matter. It is collateral with consequences. The question of ownership becomes slippery when belief is the collateral. If people collectively sustain a machine by accepting its signals, then who owns the outcomes? Look at crises for clues. When confidence collapses, governments step in with liquidity, central banks backstop markets, and international institutions negotiate rescues. These interventions reveal the true custodianship, not a single creditor, but a consortium of public and private actors committed to preserving the functioning of the system. In 2008, when mortgage debts threatened global stability, it was not only lenders who acted. Central banks, treasuries, and supranational institutions coordinated to prevent collapse. Their motive was not purely altruistic, it was pragmatic. The cost of allowing the cathedral to fall was too great. Again, ownership is less about possession and more about stewardship under pressure. So where does that leave us? The modern creditor is not an isolated king, but a dispersed process. Credit worthiness is produced by law, by institutions, by narratives repeated by newspapers, analysts, and policymakers. It is manufactured through practices, rating methodologies, monetary policy meetings, regulatory frameworks, and the everyday choices of investors. The creditor's power is therefore procedural, embedded in how markets evaluate and transact. It is a control that emerges from coordination rather than command. That coordination rewards those who can shape perceptions and allocate capital. Central banks for their credibility, big financial institutions for their networks, rating agencies for their assessments. But it also renders the entire system fragile because it depends on a common acceptance that promises mean something. If belief is the collateral, the deepest truth about debt is democratic and terrifying in equal measure. We are all participants. Every decision to trust a currency, to buy a bond, to accept a salary denominated in a particular money is a vote for the system that underwrites those claims. We sustain the creditor when we act as if the promises are real. That means the power of the creditor is not absolute. It can be challenged by new practices, by changing expectations, by shifts in economic behavior. Cryptocurrencies, alternative reserve arrangements, or simply a mass loss of confidence can all reconfigure the cathedral's light. But history teaches caution. Durable systems of obligation adapt and co-opt dissent. When innovation threatens, incumbents often find ways to integrate or neutralize it. In the end, the haunting realization is this: perhaps no single entity owns the world through debt. Instead, ownership is reciprocal. We have built a machine that both empowers and limits us, and we keep it running because it suits many of our needs. We accept debts to smooth consumption, to invest in futures, to spread risk, and in doing so, we bind ourselves to reputations, legalities, and a global choreography of finance. The creditor, then, is less a captor and more a mirror, a reflection of our collective willingness to believe in promises. If this made you question how the world really works, don't just scroll. Stay curious, subscribe, because the history of debt will keep telling you what the system won't. We will trace the ledger lines, reveal the quiet mechanisms, and linger in the pauses where meaning forms. When the next crisis whispers its warnings, you'll know to listen not only for the numbers, but for the narratives that give them weight. And perhaps, in that listening, you will find a different kind of power, the capacity to imagine alternatives to the orders we accept.